conference is now being recorded.
Vishal Gulecha, Head Retail Equities. Mr. Kedar Deshpande, Head Retail Distribution, Product and Services Group. Mr. Anupam Guha, Head Private Wealth Management. Mr. Subhash Kelkar, Chief Technology and Digital Officer. Mr. Ketan Karkhanis, Head Digital Client Acquisition and Co-Head New Solutions Group. Mr. Prasannan Keshavan, Head Operations, and Mr. Nilotpal Gupta, Head Data Science Unit. For the duration of this presentation, all participant lines will be in the listen-only mode. I will be standing by for the Q&A session. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. The business presentation can be found on the company's corporate website, ICICISecurities.com, under Investor Relations. I now hand the conference over to Mr. Vijay Chandok, MD and CEO, ICICI Securities. Thank you, and over to you, sir.
Thank you very much. A very good evening to all of you, and welcome to ICICI Securities Q1 earnings call for fiscal 2023. So I'm sure that by now you would have all perused through our investor presentation, which has been uploaded, as was pointed out on our website. I shall start this discussion with highlighting some of the industry performance for the quarter which has just ended, and then take you through some of the key areas that we have been focusing on during this quarter. So the first thing that we've seen was apparent in this quarter was there was a clear moderation in the industry. In a way, when we look at this moderating trend, it started off sometime in the month of October last year. So Q3 FY22 is when it started. It continued in Q4 FY22, and it quite sharply intensified in Q1 FY23. And this is visible from trends on multiple parameters. And I'll just take you through the parameters where this moderation is clearly visible. First, in the growth of new demat accounts that are getting opened. So when you look at this indicator, you will find that this has been losing momentum, and on a sequential basis, the new demat accounts actually declined by 25%. The second parameter is the NSE active for the industry. This grew by about 5.5% sequentially, and this growth rate is the slowest that we've seen since 2019 December. Currently, this number has now stacked up by the end of this quarter to about 20 lakh NSE active. And what is interesting is that this momentum is showing a declining trend on a monthly basis, with industry adding only 5 lakh customers on NSE active in May, which came down further to little less than 3 lakh customers in the month of June. The third parameter I want to talk about is the cash volumes. Cash volumes for Q1 further reduced, with retail equity ADTOs declining by 15% sequentially. Within this quarter, if you look at the June retail cash ADTOs, it actually declined 22% vis-a-vis May and 35% vis-a-vis March, clearly indicating that there's a weakening trend as we enter into Q2. Coming to F&O trading activity. Here, I would say that F&O trading activity fared better relative to the cash segment, with growing retail derivative ADTOs. However, what is noteworthy is that the pace of growth has moderated. It actually moderated in the last quarter compared to Q3 to 25%, and further moderated sequentially in the current quarter to 11% compared to Q4 of last year. Coming to the overall ECM activity, which is there in the industry, again this showed degrowth sequentially. It showed a growth sequentially, and this was largely because of the LIC IPO. If you look at the residual primary market activity, it was actually quite weak. Coming to mutual funds, the gross flows in equity mutual funds declined by 15% and 16% on equity and debt respectively. And flows into SIP, however, continue to show an increasing trend, and it increased by about 3% sequentially. However, what was noteworthy is that the SIP count addition declined sequentially by more than 20%. In such a context of a very clearly moderating industry, our revenue has actually grown on a YOY basis by about 6.3% and came in at about 794.8 crores. This is on the back of our efforts to diversify and texturize revenue and was led principally by growth of non-broking equity revenue and also the distribution income. However, when you look at it on a sequential basis, you will find that it has declined by 11%, and this is clearly attributable to the moderation in the industry that I just mentioned. When we talk of profit after tax actually declined 12% on a YOY basis and 20% sequentially and came in at about 273.6 crores. If I were to explain the decline on YOY basis, it is on account of lower revenue in the institutional businesses. All other businesses are actually grown on a YOY basis, and higher cost base was the second reason why this is actually declined. Higher cost base was on account of the increasing spends that we have been doing in identified focus areas comprising talent and capabilities, primarily in technology, analytics, and marketing. When you look at on a sequential basis, the decline can be attributed to weakness across both primary and secondary market activities, and also to an extent on account of seasonality in some parts of the distribution business. Under the circumstances of a difficult quarter, I would say and re-emphasize that we are completely committed to our medium-term strategy that I've shared with you in the past. However, our immediate focus as a company has remained in four important areas. The first one is improving market share across various areas of business. Second is in diversifying our revenue mix. Third is judicious cost containment without compromising on growth opportunities. And lastly, building a pipeline of business and products to be future ready. Now, coming to market share, I'll draw your attention on some of the important elements. We've been making investments in the derivative segments, and we've started seeing some early encouraging signs. If you look at our retail derivative market share, it improved from about 3.3% to 3.5% on a sequential basis. However, when you look at it from a monthly basis, June market share came in at about 3.6%, and as we've entered into the new quarter, we continue to see increase in number of customers' orders and even market share. Looking at MTF, we've maintained our leadership position with a market share which marginally increased. It went to at about 22.4%. We recently launched commodities, and commodities has been shaping up well, and we continue to gain market share there. It came in at about 4.4% in the current quarter, sequentially from 4.1% in the last quarter. With respect to NSE active, our market share remained stable at about 8.4%. With respect to Demat account sourced, our market share increased from 5.5% YOY basis to 6.5% YOY basis. Mutual fund AUM actually increased by 10 basis points from 1.7 to 1.7% from 1.6%. While on the above parameters we gained market share, our retail equity market share, I would say, remained broadly range bound and stood at about 9.7%. We continue to introduce new tools, new plans, new propositions to strengthen our offerings across all businesses, and our market share focus in difficult markets is going to be a very important deliverable from our side, and we'll remain committed to that. Second, coming to our focus area in current difficult situations is diversification of revenues. Now, talking about diversification of revenues, if you look at our non-broking retail equity revenue, it grew by 87% YOY and sequentially by 9%. This is largely driven by the growth in the MTF book, and the average MTF book on a YOY basis increased by about 97%. Distribution income grew by 28% on a YOY basis, driven by a strong performance from mutual funds, insurance, and all the remaining other products. ICICI Mutual Fund AUM excluding direct actually was up by 11% YOY. Equity AUM was up by about 20%. Revenue from mutual fund, insurance and other products grew by 21%, 61% and 34% on a YOY basis. The total distribution income on a sequential basis declined by 10%, but this is primarily on account of seasonality associated with the insurance business. Our own PMS book grew by 10% on a Q-on-Q basis and crossed about 800 crores currently. As a consequence of the above, when you look at it on a YOY basis, the contribution of broking revenue to the overall revenue came down from 53% last year same time to 38% currently. And contribution of allied revenues within equity increased from about 25% last year same time to about 45%. And contribution of distribution income actually increased from 16% last year same time to about 19%. So clearly diversification as a theme has been playing out, and within equity, texturization of revenues as a theme has been playing out. Now with regards to cost containment, I think the noteworthy point for us to share is that the cost, which has been increasing in absolute rupee terms 7 quarters in a row, actually declined on a sequential basis by 2%. This is because we reduced discretionary costs in the context of weak market conditions. While the decline itself is marginal, I think it's important to note that it's a clear commitment and direction that we are taken of containing what we call discretionary costs and focusing only on growth-oriented cost elements. And we'll continue to look at costs in a similar manner as we enter the remaining part of this fiscal year. Talking about the last aspect, which is what are the products that we are launching to be future ready. I would say that with a view to put an enhanced focus on the trading segment, we rolled out a slew of products. These are what we branded as smart order platforms, easy options, trading views which provide a much superior experience. We also have a pipeline of products like flash trade, single screen training, trading platform for high volume trader, which we've called Meta Cockpit. All these are getting launched during the course of this quarter. We launched a product which we branded Lifey as a digital assistant. This is to facilitate investors to select investment options for meeting their life goals. We consciously upgraded and continuously upgraded our markets and money app to launch several of the tools and products that I described above, and also insurance and loan products, and also focused on improving loan customer journeys. And in that context, I'm actually quite pleased to report to you that our markets app today is rated better than most of the competitive apps that you find in both Play Store as well as App Store. And this I'm comparing, including with the new age players, clearly endorsing some of the efforts that we've been taking in improving our digital offerings to our customers. We also launched iLearn, which is a new age learning platform. It is replete with short videos, podcasts, and we've also introduced an investor community platform, which is showing an initial traction, which is pretty encouraging, and it is also helping us increase engagement. Recently, we received approval from our investment committee of the board to take over the business of a company called Multipie. It's a networking platform for investors. This is, of course, subject to legal due diligence being satisfactory. And once this is done, we believe, along with the brand, the business, and the people, should further assist in modernizing our efforts to educate and engage and create network of investors on our platform. We also recently entered into an exclusive partnership with HSBC Bank, which is for them first of its kind globally, to offer a 3-in-1 broking account, just like we do to with our ICICI Bank partners, to their partners in India. This will clearly provide us access to provide equity products to their HNI customer base. On the issuers and advisory services business, markets were weak, so we used this time to build a strong pipeline. And today we have a pipeline of about 82,500 crores across 42 deals, and there are many more deals that we are engaged in. And we feel quite optimistic that as soon as market sentiment improves, many of these deals will get executed, and we are keeping them, several of them in a ready-to-launch state. So as we move forward, I think it would be fair to say that the near-term outlook remains uncertain. However, despite these short-term headwinds, we continue to believe strongly in the medium to long-term story of the segments of industry that we operate in. And we'll continue to look at all these opportunities with an agile mindset and remain committed to expand our presence and market share across the products that we offer, of course, in the segments of savings, investments, and wealth, loans, and insurance to the various customer segments that we offer. That is all I thought I will share with you. I'll end my commentary and throw it open for whatever questions you may have. Thank you very much for a patient hearing.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Our first question is from the line of Digant Haria from Green Edge Wealth. Please go ahead.
Hello. My first question is that if we look at the cash ADTO in the last 12 months, they have fallen by roughly 30 or 40%. But derivatives ADTO, even on a QOQ basis, haven't fallen much. So maybe someone like me would read that, F&O trading is probably, the future, how much ever we may like it or not, F&O trading is occupying the center stage of, the entire, equity markets. So in that context, my first question is on the F&O that, 6 months back, Vijay, you said that, in F&O trading, we need 3 things. We first need the pricing right. Second is we need the tools and the ecosystem of, to help the traders. And third is actually getting the customers and, making them stay engaged. So where exactly are we on this journey? Because we see the market share gains, but if you can give some more color, in terms of where exactly in this stage are we?
Thanks, Digant. Pleasure to talk to you after a long time. So you're very right. I think you cited some numbers. 35% broadly was the decrease in the cash ADTO, and if you look at derivatives, while on a YOY basis the growth was some more than 2.2 times on a YOY basis. I think what is to be noted is that sequentially, while it is growing at a slower pace. So yes, all the numbers that you mentioned, I completely I can resonate with what you're saying. Just one point I would comment on this is that as a company, as a firm, our approach is always diversification, not be dependent on just one singular revenue or a market opportunity. Right now it is growing. Is it an important opportunity? Definitely important opportunity. Are we committed to increasing our presence there? 100%. And how are we going to do this? As you correctly pointed out, 3 things. Actually, just to refresh, I had pointed out 4 things. I had mentioned pricing. I had mentioned reliable platform. Then I had mentioned about tools, and I had mentioned about what you said, which is the basic ecosystem of APIs and other research stuff that you can add to this. Absolutely. Pricing, I would say we have done with. Stability of our platform, I think, is very much something that we've established. I made a comment in my speech. I think the proof of the pudding is just go to the App Store, just go to the Play Store, take our rating. We've got more than 11,000 ratings which customers have given us on the Play Store. Compare it with any other new age app, and you'll find that we are right up there. I think we've kind of sort of made big progress there, and it's a big movement that we made there. So I would say platform has clearly been created. Number of tools are launched. Number of tools are coming. Even as we speak, I'm sitting with a test version which we are going to launch maybe tomorrow or maybe at first on Monday, which will throw more tools into the market. These tools are being really loved by our customers, as reflected in what their comments come in the social media and direct mails that come to us. That is what has helped us gain market share. Market share on a month-on-month has increased by 20 basis points sequentially as we entered into July. I mean, it's too early days. I mean, I would still wait for some more stability to give any sort of comment there. But I think the trends are encouraging. We'll launch more of these tools. We've got a bunch of about 7 or 8 such tools that we are launching. So they are all coming, and then it's a question of increasing popularity. Completely resonate with you that derivative important. We are going to invest in that, and we want to increase our penetration presence and make that as an important line item of revenue. But that is not going to be our only line item of revenue. We are also going to be focusing on other areas, clearly.
Right. Absolutely. My question was just because, this is the only area where probably, we are not the strongest. All other areas, there's very little to ask because we have done a good job anyways.
Completely agree, sir. We will deliver in this area. We have to deliver, and we are committed to that.
Perfect, sir. Sir, and specifically on the wealth part, the whole distribution part, not just wealth, but the whole distribution part, do you see any pricing pressure coming in the market or, across products like, MF and insurance and, wealth management? Is there no pressure on pricing?
So, Dekant, this is a competitive industry. I think clearly one cannot run away and wish away from the fact that there is a lot of competition. Entry barriers are relatively low. So pricing pressure is always knocking on our doors, whichever product that we offer. So the name of competition requires us to clearly be innovative, be more sort of relevant, and keep being reasonably priced. We've always looked at pricing with an agile mindset. We managed to hold our positions and increase market share. You mentioned distribution products. I think under-penetration is so massive in the distribution products that there is space to grow despite competition. Pricing pressure, yes, will remain. Our approach to pricing pressure is through trying to innovate, add value, and try and maintain pricing. A classic example I can give you just to make my point is on the mutual fund side. I think mutual fund, there is enough and more competition from direct plans. However, you've seen that despite that, we've managed to inch up on market share. If you look at our SIP market share has grown. Actually, it is now in the vicinity of about 1 million SIPs getting triggered on a monthly basis. This used to be 650,000 about 6 quarters back. So that's growing. We've been gaining market share there. If I recollect, it's about 3.4% market share. It used to be much lower than that 5-6 quarters back. So we'll continue to invest. The LIFE product I just alluded to is another such product which will help us do goal planning, marriage planning for buying a car, planning a holiday, and so on and so forth, and therefore what investments I should make. They are pretty cool tools that one will connect well with both affluent, younger, mass affluent segment as well as the newcomers. So idea is to grow the SIP franchise, add value, and be reasonably priced. Competition to hai, sir.
Right. No, thanks so much for the detailed answer. Just lastly, just a suggestion that, since you alluded that in these difficult markets or, in markets which are not very buoyant, market share will be a very big focus for us. So, we used to share a slide at the end of the presentation where, we can get the market ADTOs and our mutual fund AUMs and all of that. So that just made our lives easier to track that market share. If we can just reinstate that slide, that would be great. That's just a suggestion from my side. Thanks.
Yeah. Hi, Digant. Harvinder here. Just a quick clarification. So we have over the last 2-3 quarters started giving a much more detailed breakup in a separate file called disclosures, an Excel file, which has all the market shares, ADTOs on various parameters, detailed revenue breakup.
It's already there, sir. Just dig it up from there. And if there's any help, you can always clarify.
I'll send you.
It's already there.
Perfect. Then thank you so much, Harvinder, and thanks, Vijay, for very detailed answers as always. Thank you.
Thank you. Thank you.
Thank you. Next question is from the line of Madhukar Ladda from Elara Capital. Please go ahead.
Hi, good evening. Thank you for taking my question. First,
Madhukar, sorry to interrupt you. Your voice is breaking. May I request you to come in a better reception area, please?
hello, can you hear me now?
Hello. Sir, sorry, your voice is still breaking.
Hello? Hello?
Yes, sir. Please go ahead.
Okay, hi. So, just, on the retail equity and allied revenues, I see other fees and charges. That has grown quite well to 32 crores in this quarter. Maybe you can explain that. On the second thing, other distribution is holding up quite well. I wanted to understand what are the drivers to other distribution and what will, what sort of will move that line item. And finally, within retail brokerage, how much is from the cash side and what percentage is F&O, if you can sort of give that out. Lastly, what is the adoption of Neo been? Yeah, those would be my 4 questions. Thanks.
Hi. Madhukar, so the first question, others within the allied revenue, that has grown from about 17 crores to 32 crores. That's primarily on account of increase in lot of these transaction-based charges that we have introduced. So it's the entire portfolio of charges under Neo, Prime, etc., small charges. So that quantum, the overall cohort is starting to grow. That is the primary mover and shaker. You have seen that the interest income is at about 150 crores. Prime fee is at about, so went up from 26 to 30 crores. This other fees and charges, this is the prime mover and shaker.
This also includes the Neo charge, right?
Yes.
Other charges are completely Neo oriented.
So it will be Neo first time fee, it will be the payment gateway charge, demat charge, exchange transaction charge, call and trade charge, all those type of charges are
fund transfer.
So yeah, payment transfer charges. So that cohort has started to grow. That is question number 1.
Broadly from the non-ICICI Bank base customer. Would that be right to say?
Largely that could be true, but it could be a mix. So for example, within Prime also there will be some demat charges. But yes, Neo customers and Neo customers could have ICICI Bank and non-ICICI Bank customers both. Neo is a trader's proposition. Many of our existing customers also opted for Neo. So it could be a mix. It will not be correct to classify it only one way. And I will answer the 4th question also linked to this. Neo adoption is now roughly at about touching about 50 odd percent in terms of the overall trade. And the overall subscription is about 2.5 lakh. So this is the Neo contribution. You also asked about distribution revenue. It is holding up. What are the drivers for that? So on a sequential basis,
other distribution, yeah.
Yeah. So other distribution is a whole long range of products. For example, our wealth products, fixed income products, loan products. Some of these products have they are holding sequentially. The decline that we saw was primarily on insurance and mutual fund, which you must have noted. But these other products, especially these categories, we have seen holding up behavior. Our own
which categories exactly? Sorry.
What I mentioned, the fixed income distribution, loan distribution, wealth products, AIF, PMS. Sequentially, these are the ones which are holding.
Understood.
Sorry, Madhukar, there was one more question between which I missed. I think you mentioned something about E and F&O.
Yeah, the split in broking revenue between cash and F&O. If you can, I remember earlier it would be a rough sense was sort of, about 65% would be cash. 60-65% broadly would be cash.
So broadly, it will be around that range. I mean, it keeps varying in and around that range, Madhukar.
Okay. Right. I'll come back in the queue. Thanks, Amin.
Sure.
Thank you very much. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah. Hi, good evening, everyone. Firstly, while continuing on the F&O question which we had from the first participant, while there is so much attraction, the regulator seems to be talking about restricting the activity of retail in terms of in F&O. So, and we are hearing that a lot of data has been sought from brokers by exchanges as well as the regulator. So how do you think that this is panning out, and what could be the measures according to you that could be brought to restrict trading activity of F&O by retail participants, if any? And the second question is on the prime customers, where we haven't seen any addition in this quarter. So what is the reason there, and how do you see this traction going ahead? That would be my question.
Prime customers.
Okay, so you're very right. Prayesh, when you said that regulator has been asking a lot of questions. In fact, all of us in the industry, including I'm sure your company as well, would have been probably called in for these kind of conversations. I think when you get behind the skin of what exactly the regulator is looking at, I think they are concerned about A, the growing volumes, it's pretty high. B, the fact that a lot of younger, less experienced people who have come into the markets are participating in F&O market. And obviously from a sustainability of and stability of the market viewpoint, they do not want anyone to actually get an adverse experience of making these investments. So their intent is clearly to protect the retail investor and also to ensure that there is stability in the market. So I think they are clearly coming from a risk on lens, so to speak. The type of data that they have been asking and the kind of conversations have been asking is reflecting information to satisfy themselves that indeed there are enough controls, enough risks, enough transparency that is being shared with the customer, so that he clearly understands what he's getting into and he has a sense of what he's either making or not making in the market. So that is where they are coming from. Vishal has been having direct discussions. Maybe he can add a little bit of color and also talk a little bit about the prime and what's the outlook there.
Yeah, so I think the regulator is definitely interested in seeing a very robust derivatives market, but at the same time they want to take all precaution to prevent any kind of undesired experience to this retail customer. So I think we are completely aligned with that thought. And 2 counts. I mean, one is the kind of tools which we are bringing. It declutters the entire derivatives space, doesn't let customer go too far from the reality and keep customer within those the practical aspects of derivatives. Like you will see one of the products which we have launched recently, the option, which clearly tells these option traders that don't go too far and trade in something where you can lose money. So, I mean, these kind of initiatives we will keep taking. Secondly, how do we help our customers in terms of research recommendations? So, I think we are increasing our intensity there as well, so as to give a very, very guided, to customer in derivatives. Also, in terms of due diligence, etc., when customer comes to trade, I think that those steps will be welcomed by the investor community and we as well, and we will abide by whatever new framework.
I just put one comment that wherever we have seen any kind of regulatory sort of interventions, it kind of probably has short-term impact, which may be sort of reducing volumes. and activity. But I think in a period of time, the market sort of absorbs it and moves on and comes out and emerges more stable. I think, for example, I can say that in this round of market correction, which has been quite, I would say, visibly there, we've not seen too much of leverage in the market. And I think that's why while I see pain in the market, I don't see panic in the market. I think good from a regulatory stability point of view. So I think short point is that things should be eventually okay, even if there are some actions. And in any case, our dependence on one product has never been part of our strategy. We are broad-basing. We are not overtly dependent on one product. We'll continue to keep that lens as we move forward. Coming to Prime.
Yeah, so Prime in Q1, I would say that the performance or the subscription was slightly muted in comparison to Q4, but that is more to do with the market conditions and the inflow of a new set of customers. But and that also is not too out of the place. I think we will be down by only about 12% in terms of overall Prime numbers in comparison to the Q4. But when we look at any other quarter before that, I think the Q1 will still be far better than what we have done previously.
Yeah. So it is more, short point is it's more, market reflective. Our actually new account demat market share has gone up by about 100 basis points in the quarter.
Thanks for that. Just further clarity on this F&O thing. So when we source the information from the customer while allowing him to trade in F&O, what major checks and balances do we keep by allowing the customer to trade in F&O?
Yeah, so there is a format which regulator has also defined that customer before entering into a derivative segment should fulfill what kind of conditions. So be it the financial documents which customer should give to activate derivative segment, or a demat statement, or a bank account should be 6 months old, etc. So I think we do comply with all those, and before enabling any derivatives customer, all these steps are completely ensured. So that is, the guideline defined by investor, and we are complete. Yeah, and the product construct is also very, very contained. So that responsibility is with us, that we create products, which kind of gel well with this kind of people. Promoting products like stop loss products where the downside is contained, and as I said, promoting products like easy option where not promoting too much out of the money options kind of thing where the loss has been higher historically also. So those are the steps which we are taking on continuous basis, and also as well when customer comes in for the first time.
Thanks, that's helpful. Thank you so much.
Thank you. Next question is on the line of Nilesh from Quantum Advisors. Please go ahead.
Yeah, hi. Thanks for taking my question. I just want to understand, the last few quarters there's been a burst of new client additions. I'm assuming there has been a substantial marketing spend to acquire those clients. I don't know if there is a life cycle costing number. When do these clients become sort of net positive for you? I'm assuming there is an EBITDA drag because of large marketing spends that have been undertaken, but at some point these clients which are dragging margins start becoming or start adding. So is there some sense you can throw on that?
Yeah, hi, Harvinder here. So we measure internally and keep tracking something which we call as a payback period, the amount of that we take to recoup by way of revenues, whatever spends we do directly to acquire a customer. At a firm level, we have a payback period of slightly more than a year, so about 13 months or so, give or take a few months, one or 2 months, plus or minus month on month, there could be variations. And within, more specifically within the digital clients that we are acquiring, where there's a lot of scale, and it's a more recent channel, there the payback currently is slightly higher. It's about 24 months, 2 years, vis-a-vis company level average of 1 year. And what we have seen is that we started this digital acquisition journey about 2 years back. So first 5, 7, 10 cohorts are already deep in the money in terms of starting to already make profit. And every subsequent month, we keep seeing some of the cohorts turning into the green zone. But at a portfolio level, this is what the current track is.
Okay, and just on the
I'll just add one point. We've been very, very careful about not overextending ourselves on spend. In fact, I think at an overall level, the numbers don't really move the overall overall cost, not cost, but the PBT number by too much.
Okay. And just, I think in the last call you suggested you might, there would be substantial spends on the technology side. I think the number was around 60 crores or something. Is that primarily on the balance sheet, or you'll be expensing it through the P&L? How will the expense be?
Yeah. So first of all, let me clarify the numbers. So we have had a capex spend of about 70 odd crores in FY22, and we had given a guidance and an OPEX spend of about 80 crores. So that's the total outlay in FY22 already. We had said that our sense is that we're almost more than 2x is the kind of growth, but currently we expect a more moderated spend on technology, just getting it deferred between maybe instead of 4 quarters, maybe 6 to 7 quarters. So that's the stand that we are taking. It will be a similar mix of capex and opex, so part on balance sheet and part on opex.
Yeah, but just the point to be taken away is that, the kind of aggressive guidance we had spoken last time, we have started looking at it in a more judicious way, focus more on the high impact here and now, growth oriented spends, and what is good to have, we'll defer it for a little later.
On the balance sheet, I know the margin funding business, already your debt to equity is about 3 times. I know it's backed by liquid assets, but how comfortable are you and how much can you push that number?
Regulatorily, we can go up to 6 times leverage ratio. That's what's kind of enshrined in the SEBI regulatory framework on margin trade finance product. And just to understand the construct of the product, it's a secured lending, because what happens is that the underlying security for which you are doing margin trade financing, that is in a your pledge, and that has been our experience also over a long period of time. So we definitely like this particular product, and it's a part of our both diversification strategy as well as client acquisition strategy. We have enough headroom both from a financial perspective in terms of our ability to lever and from a regulatory perspective.
But is there an internal limit beyond which you'll not go? Or you're okay with going up to 6 times? Is there?
So the regulatory limit sets the bar. Today we have so for whatever lending we do or assets we create, we need to take shareholder approval. Our current shareholder approval is of 11,000 crores, and so that is the current approval, against which we are at about 8,000 crores. Given the future direction, a medium-term direction, we will shortly be taking an approval of enhancing that from 11,000 to about 15,000 crores to keep enough headroom over a medium term. Also, if I may add that apart from the basic design of the product, and by basic design I mean substantially higher margins as specified for this particular product versus any other product, overlay that with our own risk framework, which basically says that there's a set criteria for choosing the securities which will be offered under MTF. It's completely automated. It's real time. So those are some of the parameters on which we have built this business. And from in that sense, I mean, we would be happy to kind of scale this up.
Okay. Thank you. Thank you so much.
Thank you. Next question is from the line of Aejas Lakhani from Unifi Capital. Please go ahead.
Yeah, hi team. Hi team. Thanks for the opportunity. Some of my questions have been answered, but the ones that are pending are, one is, team, could you speak about the MTF and ESOP book a bit? Because, sir, Mr. Chandok, if you look at the exit MTF book, that's tapered down to 5,200. So how should one look at that for the next quarter?
Yeah. So thanks, Aejas. MTF and ESOP, to our mind, is something that is an area of focus, but we will not be moving ahead without it fitting into our risk framework. Now, there is a risk framework with what we do, what type of customers we do with, and there is a team which is very carefully administering this on the ground. In this quarter, as you correctly pointed out, sequentially, there is a marginal decline. It is reflective of the fact that there is a weak market, and inherently MTF is a product which is more suitable when the outlook of market is constructive and positive. In such a context, what are we doing? We found that the penetration number of customers that we've offered this product vis-a-vis the number of customers we have, the penetration was a minuscule percentage, and obviously it meant that there is a huge untapped opportunity sitting within our own portfolio rather than deepening within just the same customer doing more. And that's the approach we have taken. So last quarter, while the numbers might have declined, the number of customers have actually increased, which means that the gunpowder available for scale up as markets improve can be quite scale up at a short notice. That's the approach we are taking. As far as so we are actually going to be playing this by risk framework and by market opportunity combination. We don't want to do growth for the sake of it. Idea is granular, broad base your risk, spread your risk across larger set of customers, and then when the market times are right, then give him the wind to grow. That said, on the ESOP side, as we had mentioned in some of the earlier meetings as well, that we are following the RBI guidelines, not more than 20 lakhs. However, this product inherently is something that customers want larger amounts. So we have recently tied up with Chola Finance, and under that arrangement, we source the customer and manage the relationship. Chola provides the credit, which is required beyond the amount that if it exceeds 20 lakhs, so that we retain relationship. There is obviously an earning that we get because we are the finder for that particular deal. So there is some protection of revenue that we are able to manage on that. And we will continue to use this channel to scale up. Right now it is working on a physical format. We are digitizing Chola into our platform so that this whole thing can become digitally delivered to him. So that is what is going on. And on MTF, I think fair to say market share is not just holding up. In fact, I think slightly it has inched up. We were last year same time around 22%. It's gone to about 22.4%. So idea is to maintain market leadership, broad base, risk framework ke andar operate karo with the right customers. Broad base it so that when the times are right, you can scale up fast.
Got it. That's very helpful. And sir, the ESOP book, rundown that we were expecting. So is it fair, from what I'm listening to you, that the rundown could be much slower than our anticipated, and some of it could get compensated through the Chola piece? Is that fair?
See, rundown has been slower, but I think you should attribute this to a weak market. People who had taken ESOP position don't want to, because these are all very, very strong companies. They don't want to just make an exit for the sake of it. They believe that there is more inherent value when markets, they believe markets are right now in a transient stage, they will improve, and when that happens, they will sell. So decline is slower than what probably you had anticipated. Having said that, definitely both MTF growth by broad basing and also I would say Chola's presence into our business should to some extent stymie the negative impact of.
Yeah, got it, sir. Thanks for that. And Harvinder, one question to you. See, you mentioned about those other fees and charges, which were those transaction-based charges. So, is my understanding fairly right that as the derivative piece increases, because everything is neo-linked, that this number also will be reflective of the same?
It will be a combination of derivative, yes, derivative, but a combination of derivative and equity and trading number of orders. See, because it's quite diversified. If you look at the nature of these charges, something is based on number of times the amount gets transferred. Something is based on how many calls you decide to make. Something is dependent on how many system square offs happen. So it's quite diversified. So yes, broadly the level of activities
if traders business, which includes intraday trade, intraday equity, and activity on equity and neo increases, I think it'll all stack up here.
Got it.
It's not singularly attributable to neo.
Got it, sir. And so finally, is there any waning off of competitive pressures from, the PE-funded sort of brokers?
So I think market has slowed down. I mean, one of the places where we did see competitive activity very heavy was on marketing spends on acquisition. One can sense that has faded out in the last couple of months. That's one place which one can probably get a hint as to what is the stance being taken by the new age players. Beyond that, has it faded out? I think too early to comment. They are still there. They are still prominent players in the market. So we'll wait and watch what happens.
Got it, sir. Thanks a ton.
Thank you. Next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening. A few questions from my side. First is on the SIP piece. If I see your data, it seems that on a sequential basis, the SIP flows have been a little weak, whereas for the overall market, they were broadly stable. So if you can give some color on that. So this was the first question. My second is if you can quantify the tech spends and the marketing spends on the P&L during the quarter. And third, on the insurance business, if you can give some color on, what are the type of products that you are kind of, what are the product mix during the quarter and how it is shaping up?
Yeah, hi. So on the SIP, as we mentioned, the market share is 3.5%. There has been a bit of softness now, but the total number of SIPs, they continue to hold. It's about 1 million, in fact, slightly inched up from last quarter. In terms of flows, also it has been stable. There, I think a lot of initiatives like our Money app, digital client engagement with customers, simplified journey. These are some of the things which are helping in that particular business in terms of gaining share. Here also, if you look at our, SIP AUM, there our growth has been slightly ahead of industry. However, the flows were slightly soft on SIP. I think your second question was pertaining to the tech spends. So the tech spends and marketing spend, as we said earlier also that sequentially we have tried to put a more measured focus on the areas that we spend in. Marketing spends actually registered a slight decline. So they have been in the range of about 20 to 27 crores in the last quarter. That has come down to slightly less than 20 crores for this quarter. So that's on marketing spend. On the tech spend, we have been consistent. So the range has been about 20 crores or 20 to 22 crores, and we are holding up that trend in terms of OPEX for the current quarter as well.
Sure. And on the third part, on the insurance products that you kind of pushed during the quarter.
Insurance. So insurance, primarily currently the portfolio is life insurance dominant. There, if you look at it, our revenue was about 12.5 crores, which was up almost 40% on a YY basis from 7.5 crores to 12.5 crores. We are also building a line of general insurance products with our partnership through CoverStack. And there we have designed, it's in the process of getting fully launched, and we have integrated with our partners. We now have about 4 partners through which we provide general insurance products. And we have integrated two-wheeler, four-wheeler, health insurance. These are the products in general insurance, and we expect to start gaining traction in that soon. Right now, it is still dominant by life insurance products.
Sure. Thank you, and all the best.
Also, just to clarify on the last question, the marketing spend, I gave a slightly wide range of 20 to 27 crores. It is more towards the upper end last quarter. So about 29 crores was the spend for Q4 for marketing, which has now come down to less than 20 crores.
Sure. Thanks.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question. So firstly, just wanted to understand whether we've been reducing brokerage rates for our prime as well as non-prime customers.
On the rate per se, nothing specific now. We had launched lifetime prepaid lifetime prime and prepaid plans in March. So those plans basically offered on a subscription fee a lifetime benefit of the same reduced rates that we were earlier also offering. That was the change that we made. On Neo also, the pricing remains the same. On the non-Neo part also, the rate and the pricing is currently the same. We have not made any changes.
But then, Harvinder, how do I reconcile your ADTO trends and your revenue trends? Like ADTO cash is down 15, 17.
Primarily mix, because what has happened in the current quarter is that the delivery ADTO, so the waterfall in broking yield is that delivery is at the highest level, followed by intraday, followed by F&O. So that's the waterfall. Right now, delivery has been weaker in the current quarter, and therefore intraday has gone up. So it's primarily mix. On a unit rate, it is there is no other pricing intervention that we have done.
Can you give some numerical color, like retail ADTO is down 17% QOQ. Would delivery ADTO be down like 35-40%? Or at least maybe 30-35%?
Yeah, it's possible. I can maybe separately kind of come back to you with the number, but it is quite possible that within this, the delivery mix would be lower.
Understood. Okay, that answers it. Essentially, just once again, not to harp on this other fees of 32 crores. I just want to understand, have you started charging on some things that you were not charging until 4? And if not, I don't really understand what explains doubling this. And is the Chola thing also included here?
So the Chola initiative is a very recent one that I think over the next couple of quarters we will start building up. On this, as I said, we do keep looking at various charges. It will be difficult to kind of give a full breakup of what charges and what aspect of charges being competitive. But yes, there are charges that we keep evaluating and configuring. We keep benchmarking also with competition, which kind of makes the bouquet of these charges. And they are dependent on a variety of parameters. So, for example, it could be the number of sell trades or demat fee or payments, as I was elaborating earlier.
Correct. No, I'm just trying to think that how do we as analysts really model it? I know it's not a significant number, but that's fine. I'll take it separately. Just lastly, are non-employee OPEX going down? How much of that is actually due to just lower customer acquisition volumes and therefore lower referral fees and all of that versus y'all curtailing expenses on your own?
Yeah. So the two examples that I gave on both marketing is one example where we have done a bit of a curtailment. The variable cost has also gone down, and that is evidenced in our operating expense line. So that is a line which gives you the variable expense reduction on three counts. One is investment banking, second is brokerage related pass out. So whatever is the revenue share arrangement we have with various partners, that has come down. And third is what you mentioned, which is the client acquisition going down. So these are the three elements which are variable in nature, which have reduced expenses. The fixed elements are some bit of marketing expenses we have curtailed, and some of the other discretionary spends we have tried to put some curbs on.
And sorry, one numbers question. How many of your, what percentage of prime customers attrite every year?
Prime as a proposition has been a retention tool. If you look at our chart, the inventory of prime customers has been going up. It stands at about 1 million, slightly above 1 million customers as of now. It's not a very material number, not given out the exact number per run, but it's not a very material number.
And also we do see, at times that customers attrite, and that's where, we have made this proposition even more attractive by making it lifetime.
Yeah.
And additionally, 2 more cards were also introduced to attract higher value customers. So overall, we contain things in Prime. Also, Prime has now been extended to NRIs. So there also, we have seen some traction, very initial days, but I think things are picking up now.
So with the lifetime variant, Piran, actually the attrition concept for Prime is actually not relevant, not very relevant.
Got it. Okay, fine. That's all. Thank you.
Thank you. Next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good evening, everyone, and thanks for this opportunity. So firstly, could you, throw some color on the activation rate of the customers which were acquired in Q1FY23? What's the status on those customers? What percentage of those customers are still trading, are still active with us?
Yeah. So, Sahej, there are varied natures. So, for example, the cohort that we have acquired digitally has one kind of a behavior. Within that also we have seen, and we have elaborated in a few earnings calls earlier as well, that there are a few channels which have a much lower continuity rate, where the second transaction, third transaction, etc. is lower. We have also seen a lower level of activity in the current quarter, not necessarily at our platform only, but in general in the month. So that also puts a bit of pressure on the activation rate. And the third aspect is in the industry also, as Vijay mentioned, there's a number of newcomers. So what happens is it's a waterfall, that there'll be new customers who will keep coming. They are active, and some of the old customers keep getting dropped off. That rate has come down. Some of the channels, yes, we have seen a sharp decline in activity rate in their first 12-month period. And that is the reason why we have stated earlier that we are looking for more measured channel mix, and longevity of customers, sustainable customer profile. That is what we are looking at. We can expect a reduction in active client or activity level for some of these customer cohorts.
Right. I mean, so if you could just talk about the customers you acquired post after the lockdown started, around April 20, May 20, what are those customers still active? Just to get a sense, if the current customers which we are acquiring are cross-subsidizing the customers, the deactivation of those customers which are getting deactivated.
As I clarified, those customers are also active from a particular set of channels, and some of the customers may have dropped off. So it's a mix. It's not a month-wise behavior that April customers have all stopped or May customers have all stopped. There is a particular persona or a profile of a customer, and there is a channel profile. Some of the channels have resulted in weaker continuity after 12 months as compared to some of the other channels. So it's not a particular month where we can say that everyone is behaving very homogeneously.
Right. And if you just share your retail cash market share, retail ADTO cash and derivative market share, and how it has moved sequentially.
So we have disclosed that in our presentation and disclosure file. It's 9.7% for retail cash market share, and it's about 3.5% for retail derivative market share. Cash market share sequentially was 10 to 9.7, and derivative market share sequentially was 3.3 to 3.5.
Right. And just to check, what's the status on the new app which we are trying to come up with, the super app of sorts?
You're referring to the new app, which is you're talking about the new sort of brand that we spoke about, or are you talking about something?
Yeah. So during our last analyst meet, the analyst day which we hosted, we spoke about this app coming up. So the status on that.
So it's getting made. It's coming up quite well, I should say. We hope to do the launch sometime during the course of this year.
Any timelines?
We do have timelines, but these are internal timelines.
Just external broadly said.
Got it. And just to get a sense of the staff cost for the full year, the staff cost was up on a sequential basis despite a decline in our top line. So how should we build it for the full year?
It's flattish, Sahej. If you look at it, it's about 2%. That's the kind of growth, and you have to factor in the fact that Q1 you will have the impact of increments, etc. also coming in. So it has been flattish over here, and so from 172 to 175. So that has been the movement.
Thank you very much. Sahej, I'll request you to come back in the question queue. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity, sir, and congratulations for a decent set of numbers in a difficult environment. So one question, we have started this journey of open architecture almost 2 years back. So how much of our retail revenue is coming outside of ICICI Bank customers?
Nidesh, on stock, the ICICI Bank customer is still the lion's share because they are the more vintage customers, and the profile is also better. It's relatively much lower from the new open architecture set. It started and gained traction about 14 months back, if you really look at it. And there is some kind of a beginning time. So it will not be, on an overall basis, the contribution will not be very high. But the build-up and the scale is what we are...
but it's growing. It is growing. It's growing well.
Sure. Sure. And secondly, we used to disclose that more than 50% of our revenue is coming from customers acquired more than 5 years back. Is it still holds true for this quarter or?
Yeah. So 60%, Nilesh, 60% of our revenue coming from customers which are more than 5 years old. That's holding. Although we are starting to get a decent traction in the recently acquired customers also, but that metric is holding.
Okay. Thank you, sir. Thank you. That's it from me.
Thank you. The next question is from the line of Sanket Goda from Spark Capital Advisors. Please go ahead.
Thanks for the opportunity. Harvinder, we in the past guided that we have a target to get our cost to income ratio closer to 45. I understand it's a difficult environment. So whether that target will be largely missed in the current quarter, current year because of the weakness in the market, or though you have highlighted there are some levers or you have procrastinated to cost, but do we see the cost to income ratio to be upwards of 50 the way we have reported in the current quarter? And on similar lines, how do we read the employee cost, which is around 22%, and in the past we used to guide it to be around 22, but last year it was less than 20. So how do we see employee cost as a percentage of the total revenue to move going ahead?
Yeah. Sanket, so two things. One, our guidance was about 40% by FY25. That is what our aspiration was. We had guided earlier and continuously continue to guide that in interim, we do expect costs to go up. So last quarter, for example, the cost income ratio was 49%, and we had guided that we do expect this to go up in the intervening period from these levels. Currently, if you look at it, the absolute costs have actually come down. If you exclude the finance cost, the costs have actually come down by about 5%. But obviously, it's more of a function of revenue, which is playing out right now in the cost income ratio that we are seeing. Our guidance continue to be the same, that in the intermediate term, which is 2 to 3 years, we are focusing on getting the cost to income ratio to a lower level. It will be a function of revenue and our cost initiatives. So that continues to be the guidance.
Yeah, I'll just add one comment here, Sanket, that we know we'll be judicious in spend, but I don't want to compromise on growth opportunities. So we are in the investment mode, and we will judiciously and in an agile way spend where we need to spend. But what is good to have, and we'll probably defer it.
Got it. On employee cost, if you want to compare, you want to link it to the top line here.
Yeah, I'm coming to that. So on the same basis, when we had an employee cost to income ratio of 20%, we had very clearly guided that this is not the long-term employee cost trend. We should definitely see an increase on this trend. 20% was actually one quarter, and we had explained also that overall, I mean, we should see an expansion over here. We are investing in very identified focus areas in the areas of technology, analytics, marketing. Some of these areas we have identified, and we are investing, building up talent. On an absolute basis, as I was just responding to one of the earlier questions, the employee cost has gone up by 2% in a quarter, which is after increments, etc. And increments this year has been better than the past trends in the industry as well. So despite that, we have seen a 2% growth in absolute amount. So that, I think, should give you some sense.
Got it. And the second, probably another question which I had is that open architecture probably added the customers, but probably not to the revenue. But just wanted to understand, these open architecture customers somewhere have started contributing to the float part, float investment part, which was clearly missing when we were largely ICICI Bank customer company. Any trajectory you are seeing which is meaningful, which way we can highlight that and how do you see this if a regulator really comes with the APSA kind of a thing for the secondary market too?
Yeah. So the digital customers, every month, what we have seen is their contribution to the revenue and absolute revenue is rising. They are becoming meaningful. As I was just responding in the early part of the call, if you trace it back from where we started in April 2020, this journey on a small level. From April 2020 to today, June 2022, there are about 25 cohorts of customers, monthly cohorts of customers that we have acquired. Of these cohorts, the first 8-9 cohorts have already broken even in terms of their payback period, and whatever we are getting is a straight follow through into the bottom line. And this stock is becoming greater. So every month, it is not still substantial compared to the current existing vintage customers, but it is growing. Also from the revenue of a current month, that's almost equal to the cost of acquisition of that particular month. So the entire cohort is able to self-fund in a manner of speaking right now. So from that perspective, yes, it is starting to contribute. Number two, these customers are a part of what is contributing to overall float. So we have, let's say, about 1,000 crores plus of float that we have now gained. And these customers are also contributing to that. Plus, it's also contributing to roughly about 1,300 crores of float currently. And these customers are also contributing to various charges, etc. Small charges that we are levying. So idea over here is completely digital engagement, multiple charges, smaller products, and engagement. That is the plan over here, and that is what we are working on. There are various properties that we have launched, various experiences. So recently we have launched something which we call iLearn. It's an app focused on learning in a completely new age format with snippets of videos, short articles, engaging format, and so on and so forth. So all these things, and there's a team which keeps on looking at various ways to engage these customers. We have also recently invested in marketing tech stack and social networking, investor networking platform. We are building some of those capabilities to try and engage these customers digitally to have longevity as well as high lifetime value. But it is building up, is the short point.
Okay, perfect. Thanks, Arvind. That's it from my side.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for this follow-up. Just to, on that, on the part where, we take the subscription revenues, firstly, how do we account that from the lifetime fee that you get? How do you account that? And what is the kind of float that you would be earning on that? So basically, what's the size of that pool?
Yeah. So Prayesh, once we have converted them into a lifetime variant, there the accounting is instantaneous. There are two variants which are in subscription mode, the 299 variant and the 900 rupee variant. These two are still in subscription mode, which are annual fee. The annual fee get amortized over 4 quarters, 1 year. And the instantaneous lifetime fee is accounted in the quarter which we get the fee. So that's the difference between lifetime and subscription. Your second question was pertaining to what is the total quantum, right?
Yes.
So the total quantum of, so we have about 1 million Prime customers. Roughly 90% of them would be on the lower plan. So the total, so that is the Prime fee contribution. In a quarter, if you look at it, and we have disclosed that Prime fee revenue separately.
Mm-hmm. Okay. All right, got that. Thank you so much.
Thank you. The next question is from the line of Bhuvanesh Garg from Investor Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, I have a couple of questions regarding your private wealth segment. So you have given the AUM of private wealth. So in that regard, can you also give the number of customers, that how many customers you have in private wealth, and then how that customer base has grown over the last few quarters? That's first. Second thing is about acquisition, that how are you acquiring these customers? Is there any separate vertical to acquire these customers apart from the normally the way you are acquiring mass affluent customers? And third is the customer mix, that how many of these customers are from the ICICI Bank channel, and then how many of these customers are at ICICI? And fourth one is on your team within the private wealth, that how many RMs are there and how the team is structured to cater to these customers. And finally, your vision on this private wealth, that firstly, what is your target customer segment, and where do you see your private wealth AUM going and its contribution in overall revenue? Yeah, those are my couple of questions.
You've asked a bunch of questions. Let me go one by one. Your first question is that how many customers are there in private wealth, right? I think, did I get it right?
Right.
So, first of all, I'll take a minute to describe what is private wealth definition by us. Any customer individually has got ₹1 crore of AUM with us is what we call as a private customer. If you look at the total number of such customers today, we would have crossed 70,000 customers meeting this cut. And during the quarter, we added about 1,600 customers to this cohort. The total aggregated AUM from all these customers, 70,000 customers, would be slightly lower than 2.8 lakh crore as on June 30th. So that's the total AUM. If I have to describe what is the profile of this customer and a little bit about their persona, I think it is fair to say that most of our customers that we have acquired are not typically the born rich customers, but they are grown rich customers. These are customers who started off their careers as either a self-employed person many years back, and he has scaled his business up and he's become a rich person today, or alternatively a professional who has risen the ranks in a corporate setup and today is belonging to a senior management position, and he's a wealthy person in his own right. Therefore, if I were to translate this into an typical AUM that this person has got, he would be typically between, let's say, 2 to 3 crores at the lower end of the spectrum at his AUM level, and go up to 30-35 crores of AUM at the higher end. This whole segment is a sweet spot. This segment, we believe, is the fastest growing wealth segment in the country. Number two, it is a segment which is, I would say, very fertile from a they are more DIY style rather than the segment which is very pampered style, the born rich guys, and therefore they relate very well with the brand. They have come to us because they have partnered with us in the past and they have grown over the period of time. Our strategy has been, and our customer segment has been brand led rather than RM led, and I think that's a very unique differentiation of our wealth franchise. We have very strong ambitions in this segment. When we started focusing on this segment about maybe 3 years back, it was roughly 1/3 the size of this. In 3.5-4 years, we've tripled the size. We have brought sharp focus. We have improved revenues similarly and by the similar sort of proportions. And clearly, we have emerged as today the largest, I would say, non-bank private wealth company in the country. We have overtaken everyone else in the process. We will continue to put our pedal on this. and broaden our presence and deepen our presence. Today, these are serviced by a team of about roughly 300 relationship managers. They are also in turn supported by a bunch of product experts in this space. So if you add all these together, it would be in the ballpark of about 350, 375 kind of people servicing this entire segment. What else did I miss? I think
you also asked, I think, about the rate of acquisition of customers. So
I mentioned about roughly 1,500 customers in a quarter. Yeah. That's broadly the run rate.
Right.
Anything else?
Just outlook, I mean, what are your targets in next, say, 2-3 years? Where do you want to see the AUM growing or its contribution in overall revenue?
So I think we feel that rather than chasing a target, we will chase the opportunity. It's a massive underpenetrated opportunity, growing opportunity. We just want to maximize it. I think we are not looking at anything, and we want to do the right things, because see, it is very, you go chase a number, you will land up with a bunch of customers who will be very upset with you. We don't want to do all of that. We want to grow this segment in a right way, because for us it is about longevity of customers. That is how this DNA of this company has been, because many of our customers have spent 15-20 years of their life, and we find that the lifetime value of these customers is enormous. So for us it is about getting the right customer and serving him well and growing with him, and we will do that in a very, very, I would say, focused and active manner. And tripled in less than 4 years is where we have what we have achieved following this approach, and our approach will be to intensify it. So let us see where we go.
Sure, sir. And just one last thing on this, if you can just give the breakup into non-ICICI customers in private wealth, these ICICI customers.
I think it would be fair to say 100% of the 70,000 would be belonging to the ICICI fraternity. Even if there is any, we don't look at it like this, but our sense is that it will be close to 100, or Anupam, our wealth head, wants to just chip in, so maybe he will add a couple of comments around that.
So, from a client perspective, again, as Vijay just mentioned, that we have fairly robust in the specialized team. We have in excess of 300 private bankers. So we go out in the market and do open market sourcing as well. And that we've been doing, over the years. Having said that, as Vijay mentioned, that we also have a lot of clients who, have been part of the ecosystem for a long period of time, where we've deeper mined and really grown. So it's really a combination between, a large part from the existing base, as well as trying to look at it from an opportunity and trying to onboard clients from the open market sourcing. And from I hope that answered.
So the line for the participant dropped. As there are no further questions, I will now hand the conference over to Mr. Vijay Chandok, MD and CEO, for closing comments. Mr. Chandok,
thanks a lot. Thank you everyone for a patient hearing. Thanks for the support you've been giving us. We will connect with you in the course, and if there are any follow-up questions, unanswered questions, please feel free to reach out. We are all there to respond. Once again, thanks a lot and good night.
Thank you very much. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.